Listen, banks are not designed to protect your wealth. They are designed to profit from your liquidity. This is about protecting capital, not preserving comfort. And I've already seen what happens when rational people assume a deposit is the same thing as safety. Most investors make one mistake with banks, and it's not that they choose the wrong bank. They misunderstand what a bank account actually is. A bank deposit is not custody. It is a loan you are making to a leveraged institution, callable on demand, while the institution funds itself with your money and invests it into assets that can't be liquidated instantly without loss. That model works perfectly until confidence disappears. And confidence disappears faster than regulators can hold press conferences. So when I say, don't trust your bank with this if you want to stay rich, I'm not talking about paranoia. I'm talking about concentration risk in the one place people still allow themselves to be careless: cash. Because cash feels inert. It feels neutral. It feels like the one thing that cannot surprise you. That's the illusion. Now let's reframe this properly. People treat bank risk like a binary: safe or unsafe, solvent or insolvent, insured or uninsured. That is amateur thinking. Bank risk is a continuum of access and timing. The real question is not, will I eventually get my money back? The real question is, will I have my money when I need it? If you run a business, if you manage payroll, if you're funding an acquisition, if you're paying taxes, if you're carrying real estate, if you're simply trying to keep optionality in volatile markets, access is the asset. In a bank event, access is what gets rationed first. That is why sophisticated capital does not sit in a single institution out of habit. It is segmented, it is structured, it is treated like exposure. And this is exactly where people with meaningful balances get hurt, because they behave like retail depositors while living like institutional depositors. Now I'm going to ground this in how these cycles actually play out. I've watched multiple periods where the public was told the system was sound, while money quietly moved behind the scenes. When stress hits, there are always the same phases. First, denial. Second, reassurance. Third, liquidity measures. Fourth, consolidation. Fifth, the quiet rewriting of the rules. If you wait for phase 4 to adjust, you're late, because by phase 4, the market has already repriced your options. You need to understand something. Banks don't fail slowly anymore. The speed of withdrawals has changed. Digital banking has changed the physics. Social coordination has changed the physics. Large depositors can drain liquidity in hours, not weeks. So the correct approach is to build a cash system that doesn't require you to predict the next failure. You design it so you don't care. That's what wealth does. It removes dependency on any single point of failure. Here's the core framework I use. 4 buckets: no emotion, no hero worship of institutions. Bucket 1, operating cash. Bucket 2, reserve cash. Bucket 3, strategic liquidity. Bucket 4, long-term capital. Most people incorrectly keep bucket 2 and bucket 3 sitting in bucket 1, and then they act surprised when the bank reminds them, "We are not your treasury department." So let's define each bucket precisely. Operating cash is money you need for normal life and business function, near-term expenses, payroll, bills, planned purchases. This money should be highly liquid, boring, and distributed intelligently. The purpose is continuity. Reserve cash is money you do not need this month, and you do not need next month, but you keep it because you respect uncertainty. The purpose is safety and optionality. Strategic liquidity is dry powder, money you hold specifically to deploy when assets become mispriced, when sellers become forced, when spreads widen, when the market offers you deals it doesn't offer in calm conditions. The purpose is advantage. Long-term capital is money that should not be sitting in cash at all. This is capital allocated to productive assets, businesses, real assets, instruments with yield, and exposures designed to compound over years. If you collapse these buckets into one checking account, you are not conservative, you are careless. Now we move to the don't trust your bank with this part. What is this? This is any amount of cash that exceeds what you are willing to have temporarily inaccessible. That includes business operating balances. That includes concentrated personal cash reserves. That includes proceeds from a property sale. That includes a liquidity event sitting in a single account until you decide what to do. That includes emergency funds above what is structurally protected through your setup. That includes cash you cannot afford to have trapped behind a weekend headline. If you're holding 7 figures in a single bank deposit account because you like the relationship, you're not thinking like an investor. You're thinking like a customer. And customers are not protected the way they believe they are. They are managed. Now let's talk about the mechanics of why banks become dangerous specifically for wealthy depositors. The modern bank failure is driven by three forces. Number one, interest rate risk. Banks hold large portfolios of fixed-rate assets, securities and loans, that lose market value when rates rise. Even if they intend to hold to maturity, the economic loss is real, and if withdrawals force them to sell, the loss becomes realized. Number two, funding concentration. If a bank's deposit base is concentrated, particularly in larger, sophisticated accounts, those depositors move faster, coordinate faster, and do not behave like sleepy retail money. Number three, confidence contagion. Once one institution fails, depositors don't perform forensic accounting on their own bank. They simply decide they don't get paid to take the risk, so they move. The moment depositors ask, "Why am I here?" the game changes. And here's the part most people still don't fully internalize. You are not being paid to be a bank's unsecured creditor. A deposit, beyond what you truly need for daily operations, is often the lowest return, worst compensated risk in your entire balance sheet. If you want yield, you can get yield. If you want safety, you can get safety. If you want liquidity, you can get liquidity. But leaving excess cash sitting in a bank at a low rate is usually a combination of low yield, concentrated counterparty exposure, and behavioral laziness. That is not a strategy. Now we get into what disciplined investors do instead, without pretending there's one perfect solution. There are only trade-offs. The first move is structural. You diversify institutions, not because you distrust one bank, because you refuse to have a single point of failure for liquidity. If you hold large cash balances, you spread operational cash across multiple institutions. You set clear internal limits per bank. You do not exceed them because it's inconvenient to open another account. Inconvenience is cheaper than illiquidity. The second move is categorical. You separate bank deposits from cash equivalents. This is where wealthy people quietly create distance between themselves and bank balance sheets. Cash equivalents are instruments designed to behave like cash while reducing bank-specific exposure. Short-term government obligations, high-quality short-duration instruments, certain conservative cash management vehicles. The point is not to chase yield. The point is to change what you are exposed to. Because bank deposits expose you to the bank, high-quality cash equivalents expose you primarily to the sovereign and the short end of the curve. Those are different risks. In a stress event, those differences matter. The third move is maturity control. When you hold excess liquidity, you don't lock it away in long duration. You keep duration short. Short duration means you can reset your yield as rates change. It means price sensitivity is limited. It means you keep control. Long duration can be appropriate for long-term capital when the valuation is right. It is not appropriate for money whose primary job is to be there when other people can't access theirs. The fourth move is operational readiness. Most people only discover their cash structure is weak when they need to move money quickly. So you build readiness ahead of time. Multiple accounts already opened, transfers already tested, wires already configured, authorized signers already in place for business accounts, brokerage cash management already established if that's part of your system, a clear policy for where inflows go and where outflows come from. Wealth isn't just assets, it's systems. Now, let's address the uncomfortable truth that sits underneath all of this. Banking has become more regulated, but it has not become less fragile. Regulation changes incentives, it changes reporting, it changes capital definitions. It does not eliminate the core mismatch, short-term liabilities funding longer-term assets. And when rates rise quickly, that mismatch gets exposed. That's not political, that's not a conspiracy, that's duration math. Now I'm going to talk about the 2023 regional bank failures because they are a clean case study of modern stress. What happened was not mysterious. Rates rose fast. Bond portfolios lost market value. Depositors moved faster than management could respond. Liquidity became the issue before solvency could be argued on television. And once the crowd decides, "I don't get paid to stay," the institution is done. The result was predictable. Deposits migrated to perceived safety. Money moved into higher-yielding cash alternatives. Regional banks faced higher funding costs, lending tightened, and credit conditions changed for real businesses, not just traders. That is the actual consequence of bank stress. It changes the price and availability of credit across the economy. If you run a business, you already know this. When banks are under stress, they don't tighten a little, they stop. And when banks stop, alternative lenders step in at higher rates, stricter covenants, and less patience. So the banking discussion is not just about where you keep cash. It's about understanding the second-order impact. Who gets financing, at what cost, and under what terms? Now we deal with the counter-arguments because people always reach for the same ones. Objection 1. But my bank is a big name. It's too big to fail. I don't build financial systems around slogans. A large institution can still freeze activity, slow payments, change transfer policies, implement friction, or become the subject of sudden regulatory intervention. Even if the institution survives, your access can become conditional. The entire point is to avoid dependency. Objection 2. The government will backstop deposits. They might, they often do, but you do not control when, how, and under what conditions. And you don't control what the market does in the hours before that announcement. I don't plan my liquidity around the hope that policymakers will be fast, decisive, and clean. I plan as if I'm responsible for my own solvency. Objection 3. This is rare. It won't happen to me. Bank stress is not rare. It's cyclical. What changes is the surface story. In one era, it's bad loans. In another era, it's derivatives. In another era, it's duration. In another era, it's commercial real estate. In another era, it's something else. But the underlying reality is constant. Leverage plus mismatch plus confidence equals fragility. And fragility is not something you debate. It's something you structure around. Now let me give you the forward-looking warning without theatrics. If rates remain higher for longer, or if the economy slows while funding costs stay elevated, pressure will concentrate in the parts of the banking system that rely on cheap deposits and long-duration assets. That pressure does not announce itself early. It appears in quiet outflows. It appears in tighter credit. It appears in higher deposit competition. It appears in consolidation, quietly at first, then suddenly. And the people who will pay for it are not just shareholders. Depositors pay through friction, reduced access, reduced service, and the subtle but real cost of uncertainty. If you are sitting on large cash balances and you have not built a deliberate structure, multiple institutions, segmented buckets, short duration, operational readiness, then you are making a bet you don't need to make. You're betting that the next stress event will not touch your institution at the exact moment you need liquidity. That is a bad bet because the payoff is nothing. You gain nothing by taking that risk. Now I'll tell you what I would do, in principle, as someone who protects capital for a living. I keep operating cash in banks because banks are useful for transactions. But I treat operating cash like working inventory, not like wealth. I keep reserves in instruments designed for reserves, not in a single checking account out of habit. I keep strategic liquidity short duration and highly liquid, so I can deploy it when the market offers me forced selling. And I keep long-term capital invested in productive assets because that is where compounding lives. That's it. That's the system. Not exciting, not emotional, just correct. And a final point, because it matters. If you're wealthy, your risk isn't that you'll be wiped out. Your risk is that you'll be inconvenienced at the wrong time. You'll miss a window. You'll miss a deal. You'll delay a payroll. You'll hesitate during dislocation because your liquidity is trapped behind processes you never tested. That's how real money gets lost, quietly, through timing and access. Now the controlled call to action. If you want more analysis like this, cold, practical, and built around preserving optionality, subscribe. And watch the next piece because I'm going to lay out a disciplined cash architecture, how to segment liquidity, how to think about duration, and how to reduce single-point failure without turning your life into administrative chaos.